Alright, welcome back, everyone, to Lunch at the Market. I hope your weekend was a great one, which might not be true if you're a fan of half of the top five in NCAA basketball, with Duke, San Diego State, and all Texas all getting upset over the weekend. Don't worry, basketball fans, all of life's questions, or at least who has the greatest basketball program in the land, will all be answered soon enough because tomorrow it's March, and that means that we're about to have a pandemic-size March Madness epidemic spread the globe. That is, if you're a Big East fan, because they're about to send 10 or 11 teams to the NCAA tournament, which should start later this month. March Madness is one of our favorite times over here at the office, and we might just have to switch at least one of the televisions to CBS to check out all the tournament action. We'll leave the other one on CNBC. All right, enough about NCAA basketball. For now, that is. Alright, you're also likely a happy camper if you came in today to find Mutual Fund Monday in good shape. Unless, of course, that is, you own a high flyer. Seriously, spin the wheel on everything from Akamai and Amazon to Mollycorp, Netflix, and Salesforce.com. All are getting absolutely whacked. Well, it's certainly never great to have that kind of feeling on a Monday, to find the names you care most about getting pasted. The calendar is starting to work in our favor, and options expiration is now only 18 days away. Out-of-the-money options will really start to lose their luster as we draw closer to options expiration. But it's not the out-of-the-money options that we're really concerned about. It's the ones that have become in the money. Netflix has crossed 210. Mollycorp is below 48 again. Akamai below 40 again. We need these stocks to have a nice rebound in the next 3 weeks, or at least get above those levels to dig us out of a hole. We'll, of course, employ our tried and true rolling down and out solution for trade repair if we get in trouble closer to options expiration, but we are not ready to wave the white flag just yet. Now, looking at Salesforce.com, which is really the worst hit of all the names, we clearly could have done a better job of trade repair. We had a put butterfly on that would have captured all of the down move today. But the normal pattern has been that the stock moves the day after the earnings report. Well, in our case, Salesforce.com moved up huge amounts and now has successively sold off day after day after day after the initial gap up. That is probably a bearish reversal or an outside reversal, which Guy Adami would flag and say is an absolutely unhealthy technical pattern. Not only are we seeing some unhealthy technicals on Salesforce.com, but if you take a look in the Wall Street Journal, an article by Brett Aarons last Friday pointed out the very bearish case of Salesforce.com. And the reality is they're spending quite a bit of cash these days to achieve the growth numbers that they're putting up. Eventually, those numbers can't be justified. For instance, they spent around $13 million to purchase a piece of land in San Francisco when they could have bought a whole entire building for about 92. So who knows what's going on, but they are adding headcount in a big way at Salesforce.com. So either the stock is going to grow into the valuation that it has, or eventually the spending habits of the company are going to catch up to the balance sheet, and eventually Salesforce.com won't look as attractive as it looks on paper. So the reality is that with all of these high flyers, Netflix, F5, Salesforce.com, we need to be careful of the multiple that they're trading for, because eventually the price of a stock is simply just a math problem. M equals P divided by E. M is the multiple that the market will pay for the company, which right now on these stocks is extremely high. But P is price and E is earnings. And eventually, the multiple that a stock trades with eventually comes back down to earth. If you take a look at names like Apple, which have risen year after year after year after year, they've also backed it up with amazing cash flows, amazing revenue numbers, amazing products being moved. I mean, if you take a look at a company like Apple, it's still not expensive. Forward PE numbers on Apple are in single-digit range or just barely over the 10 mark. That's not stretched valuation. Whereas names like Akamai, Salesforce.com, F5, those guys, VMware, if you take a look at multiples on those stocks, they're trading closer, to between 70 and 100. So, look, we're not going to call the top on a stock or a market, but caution, extreme caution should be exercised from here. And to be honest with you, I have to say that it was probably a huge sign to kind of turn around and go the other way when Whitney Tilson covered his shorts. Guys like Tilson, Einhorn, Buffett, Berkowitz all made their fortunes in the same way, buying out completely out of favor, totally unloved companies that were trading at stupid valuations and holding them until the rest of the market agreed with them, either months or years later. Very few people have done it the IBD way, which is to buy high and then sell higher. And most of the big names on Wall Street, none of them do it this way. The value managers that have been around for decade after decade made their money by getting in when nobody loved the story and getting out when everybody loved the story. And I think we're approaching those levels in many of these names. So try to make this the last month that you have a position in, unless you're just extremely comfortable or you've got great protection in place. Certainly both are available, and there's a number of option strategies that you can use to take advantage of this. We're probably going to take a look at turning a lot of these trades into iron condors, as it seems like a lot of them have run the course. We're already short the put spreads. Now it just means adding selling call spreads above the most recent highs, and then looking for those stocks to really not reach that again for some time. So be careful. Up 100% in 1 year is not a bad story. So if you're long the stock, please, by all means, either buy some puts immediately, put a collar on it like we did on our Apple stock, or just simply exit the position and look for a great re-entry point. Jim mentioned last Friday getting back into Netflix if it broke 200. So, all right, be careful out there. These hot potato, high-flying stocks that have been passed around the market are down between 2 to 6%. Netflix is down 4%, Salesforce.com is down 6%, so they're absolutely getting pasted. The market is a lot weaker if you look under the hood than if you just take a look at the major averages. All right, thanks for joining us again today on Lunch of the Market. Have a fantastic day, and we will see you tomorrow. Remember, be careful out there.